each of us has a different philosophy around money, and we have different risk tolerances, and there's different things that are weighted with importance on a different level for each individual person. And the problem is we're not taught how to decipher what our investor DNA is. We're not taught any of those things.
Here with Wealth Energetics, I've got my new friend here, Charles Newton. We've just gotten connected through Life 180 and Chris Kirkpatrick, and we were coming together today to talk life insurance, talk abundance, talk money, talk all things that we're passionate about. So we're going to have a good time. So thanks for joining us. And Charles, good to be with you, man.
Yeah, likewise, brother. Thanks for having me on board. I appreciate it.
Yeah, you bet. So, we've gotten to know each other a little bit here in the last, 3-4 months. And, I think your journey is a unique one. We were on a live yesterday with Chris, and you got to share a little bit about that. And I know you've got a really unique story and perspective around life insurance and helping people. So I'd love to hear you, tell a little bit about your journey and what you're up to in the life insurance world.
100%, man. Yeah. So my journey started back in 2019 with this whole life insurance and, cash value, infinite banking deal. I came across it with Garrett Gunderson. I know you're a big fan of his. I am too. And so during that time, I really was interested in it, but I was running a business and we were growing fast, and I didn't really have enough money to allocate towards life insurance. I did have a convertible term policy that I could convert to a whole life policy at the time, but I just didn't feel like it was the right time. So come 2020, we had 2 yoga studios, brick and mortar studios, and we had 27 employees. And, we had big aspirations of growing that business to over 100 locations. And COVID hit, and it just completely took the wind out of our sails. We were bleeding money. And, 2 months into that shutdown, we just threw in the towel because it was cheaper to end the business than to keep it going and then just bleed out altogether.
Yeah.
So I had to, just dig myself out of that, all the debt that we'd accumulated trying to keep the business alive through the whole pandemic. And, I was able to dig myself out of that debt. And in the back of my mind, I was like, I was always thinking, well, I want to do this whole cash flow banking. I want to do, get a whole life policy for myself. But I didn't really trust any of the people that I was talking to, because I was the worst client that you could have. I was just calling everybody and, going through their whole process and everything. And over time, I was like, you know what? If I'm going to do this, I have to actually become an agent to see what it looks like on the back end. So that's exactly what I did. I went through the whole process, and I found Chris Kirkpatrick with Life 180. And I joined his agency so that I could just really understand the whole process. And I became really passionate about everything. And, throughout the entire process, I've always questioned, I was like, because there's so much information out there with whole life, right? And with all that misinformation, I kept questioning, is this even legit? Should I be doing this? Is this an actual scam? And what I realized through all my research is that it's not a scam at all. But I had to go through that whole process to discover that, right? And so here I am. My mission is to make, the whole life and the whole infinite banking concept and all of that as transparent as possible and simplify it as much as possible. Just because there's so much misinformation out there. And I think it's such a valuable tool that we can implement in our lives. And I just really want to empower everybody to have that same capability in their life.
Yeah, love it. So as you're talking about that, it makes me think to, you're talking about some of the misinformation around whole life. And I know when I first got into it, my very first seminar that I heard about infinite banking, or what was dubbed private banking seminar I went to, and I called my dad and I called Jeff Finley, and they were both kind of like, I don't know, that sounds, kind of skeptical, a little scammy, I'm not sure you got all the facts there. And then just like you do a little due diligence and you figure out like, okay, you figure out where the boundary is over here on like the traditional whole life people, and then you go over here and learn all about the IBC. And there's some people that I think stretch the IBC message maybe past where it should be, right? There's kind of an, I think we all think we're in the middle of the spectrum, but I think what we've been taught through Chris is a pretty conservative middle ground where we see where the likes of Dave Ramsey, where they bash on whole life, where they're completely off base. They don't have all the facts. In fact, they're giving you a lot of some of the videos I've seen of Dave. It's like, I don't know that you said one factual statement about whole life in the whole clip. It's like, really, you're a financial guru, but nothing came out factual there. You're talking about Prudential is a mutual company, and that was like where they demutualized in like 1990 something, and he just is way off base. And then there's the guys that stretch the IBC message to be where it's like you're just going to get rich off of how much growth there is in the policy, and you can always have positive arbitrage. And while some of that stuff is true, it's taken out of context in a way and stretched for marketing purposes, and it can give a false light. So in that spectrum, I'd love to hear what your middle ground perspectives are on like what are the misleading things about whole life. If somebody's listening to this, maybe he hasn't really delved into the whole life discussion. If you're on the traditional camp and you went down the street to your local farm bureau insurance agency and said, I'd like a whole life policy, would they write you the same kind of policy that we're talking about, or would it be different? So share with us a little bit about what you've seen is what's the landscape in whole life, and where the misleading pieces come in from what we talk about with it with infinite banking and cash value life insurance.
Yeah, so I'll start off with um, how your average experience with a whole life policy would be in dealing with your stereotypical, you know, insurance agent. They would most likely be gearing that policy towards mostly base. And for those of you that don't know, if you're gearing it towards base, like let's say that policy was written with 100% base, what that's going to do is it's going to give you as little liquidity as possible, but it's going to pad the wallet of the insurance agent, right? And so whole life insurance agents are incentivized to write more base for each policy that they write. Now, most of the time, that's not the best thing for your client. There are cases that it is, but it's that's not the normal, or that's not your average case. Most cases you want to have what's called PUAs, paid up additions. And when you have mostly paid up additions, what you're doing is you're gearing the cash value as much as possible. You're gearing that liquidity for that policy to break even as quick as possible. So instead of your policy breaking even after 15 years, you're breaking even after 5 to 7 years, which is a pretty efficient policy. So that's why whole life gets such a black eye, especially with the Susie Ormans and the Dave Ramseys, and they say it's a horrible investment. And I agree with them. It is a horrible investment. Mm. But we don't view whole life insurance as an investment. We view it as an asset, and we view it as a foundation to your finances. And I don't think whole life will fix everything, but it does play an important role in your life. I think for most people, it plays an important role in their finances, and that's the base, that's the foundation that their finances, I feel like, should branch off of, so they can go out and invest in the market or in indexes, but at least they have that whole life policy, in the first place. As far as misinformation goes, and like the whole IBC concept, I have a problem with infinite banking concept. I have a problem with the verbiage of it. I don't think it's infinite, and it's also not banking. Now, you're using a life insurance policy. It's a life insurance contract, and you have access to that money. So it acts as a bank, but it isn't a bank. It's probably safer than a bank. Banks utilize it with bank-owned life insurance, BOLI, and it's an important part of their portfolio, but it's not a bank. So even just that verbiage kind of turns me off. And I've spoken to like Tom Wall, who's a PhD in whole life, and he hates that whole concept, but he's also geared more towards not necessarily the traditional 100% base whole life, but he just views it from more of an insurance standpoint than he does the whole IBC, infinite banking, cash flow banking concepts. He still utilizes it. He's bought houses and stuff like that. And it's really like the foundational asset within his portfolio. But but when I view whole life, it's a piece of the puzzle, but it's not an all-inclusive thing. Like IULs, that's a hot topic right now, right? IULs are viewed as like a one-stop shop, and that's furthest from the truth. And so that's a whole nother rabbit hole, and people intertwine the two, and that's super negative to the whole industry as a whole, because it's just a completely different monster, and there's a lot of moving parts that most people don't even understand with that whole financial product. So
Yeah, totally. Yeah, I think back to some of the clips I've seen of Dave Ramsey and some of the misrepresentations that he claims are made about whole life and why it's so bad. And I think one of the things that really gets me right off the bat is because he goes right to the comparison of the cash value in a whole life compared to the mutual funds that he touts. And he's comparing those. And to me, knowing what we know as educated professionals in this industry, that if you're making that comparison, you're either very ignorant or you're trying to position it in a way that's not meant to be positioned, because you're not comparing apples to apples. If you're comparing whole life and cash value in a whole life to, say bonds or a savings account, that's an apples to apples comparison. But if you're going to jump to bashing whole life and its poor performance compared to a mutual fund, that tells me right away that something's up. You are either not educated fully on the product and you shouldn't be speaking about it, or you have something that you're trying to do and you know what you're trying to do and you're trying to purposely put a false light on a product in order to pitch another one. And I don't know where Dave falls. I don't know, his heart on that, but that's one of the first red flags for me is anybody that I hear on TikTok or any of these places that, they're talking life insurance. If you're making these comparisons that aren't valid, then I can't even really listen to much more that you have to say, because like the square one, you're off base, and there's so many of those types of things in whole life. There's the cash value. Well, it doesn't compete with, a mutual fund. Well, we're not trying to get it to compete with a mutual fund. Now, I've got a mentor that said there's times where it can compete with a mutual fund, and sometimes it can outperform one depending on the year. It's not like it's out of the question that it can't do it, because I think one of the arguments that we've done some presentations on in the past is, well, the whole life you're only getting 3%, in it, and maybe up towards 5 with dividend. So, well, it's not going to perform very well, because I can get like 7 or 8 or 10 or 12 or whatever number you want to pull out of your butt from, the market type funds, whether it's mutual funds, index funds, or whatever. And we always educate people on, we're not talking apples to apples there either, because you're 10% in a mutual fund, you've got to subtract tax off that.
And fees.
In fees, exactly, to get back to, what a net result is going to be in your personal finances. On the whole life side, we're not trying to put a bunch of money in whole life to make you rich, but it is taking advantage of a very powerful math concept of compounding interest, that there are never any, negative hours or weeks or months or years inside that policy. It's going to continue to always be positive growth, but there's no taxes taken out of it. So, okay, what's your tax bracket, and reverse engineer that number? You're talking almost pretty close to apples on that. So I find some of those misrepresentations also to be, okay, the person obviously doesn't know what they're talking about, because they're not talking about the net result, which can be very close. I mean, sometimes, yes, a whole life policy still may not be quite as good as a mutual fund, but it can be close. And if I have the certainty and guarantees that come out of a whole life policy to grow my cash value versus the roller coaster that can take place with all the different vehicles that are tied to the market performance. And from family to clients to just people you hear at church or wherever it's at. I mean, everybody, when the markets are down, people get stressed. I mean, you show up to a family gathering, and I think it was this last Thanksgiving, being at the kitchen sink with my mother-in-law doing dishes after Thanksgiving, and she's talking about how bad the markets have been performing and how, low her portfolio is, and it's like, I don't have to worry about that with my whole life policy, like taking that risk right off the table. So, those are a few of the things that stick out to me as misrepresentations around, whole life, that seems like they get a bad rap, but then when you really dig into them and look at them closer, they kind of aren't really what they're painted to be. That whole life isn't quite so bad. And actually, when you realize how much whole life can do and how it's a very flexible asset that can go with you all the way through your life, and start pointing the light on what is it that's so powerful about these instruments, that's where it's like, oh, okay, they're definitely being misrepresented, out in the mainstream. You can get into why is that happening. I won't probably go there right now, but those are some of the things that stand out to me. So what are some of the things that stand out to you, Charles, on, we talked about the misrepresentations of whole life, but where do you feel like whole life is such a powerful asset for someone to have in their portfolio to create that solid foundation?
So first and foremost, with our rising interest rates, it I'm sure a lot of you have heard of the 60-40 bond versus equity portfolio. Well, that model's dead in a rising interest rate environment. It's not a viable solution. The reason being is, I believe since the 80s we've been having a drop in interest rates. So that portfolio worked great. But the problem is you're using those bonds as your safe money in your retirement portfolio. And there's still risk associated with bonds. You can lose money with bonds. And so with whole life is an alternative to bonds with zero risk. And it actually scientifically proven that if you have a standard rating or better, after a 10-year period, you have a better risk adjusted return with your whole life policy than you would a bond portfolio, which is incredibly important with your retirement. So you were talking about how your mother-in-law was complaining about her accounts taking a hit. Well, if she had a whole life policy in place with a good amount of cash value in it, she would actually not have to worry about that as much, because she can ride out any wave because she has her safe money. She has her bucket of safe money, and that will allow her to ride out those ups and downs of the market. So it's a far better strategy than if you were to just put all your money in stocks. And so many people are worried about, well, what's my rate of return and this and that, but they're not thinking about the whole issue holistically. They're just thinking about how much money they can accumulate. But the accumulation phase and the distribution phase are two entirely different philosophies and strategies, and there's different rules involved with them. If you just have nothing but equities in the market, the safe withdrawal rate for that in retirement is 3%. So if you had $1 million, that's $30,000 a year. Like, that's poverty level. That's a poverty level income. And by having a whole life policy, you can increase that income by 25 to 50%, and at the same time reduce your risk, like dramatically reduce your risk by utilizing that strategy. And these things aren't this is scientifically proven by the findings of Dr. Wade Pfau and Tom Wall. I mean, they're using these things called Monte Carlo simulations, and they simulate all these different environments. And what they found is that's the most efficient way to have a distribution is by utilizing your high growth money, which is, maybe your 401k or whatever, and then having that whole life policy as your buffer asset, as your volatility buffer. And so those two combined are super powerful. And most people don't even know the power of those two financial concepts working together. And that's what really gets me fired up, is just helping people figure out what their distribution plan is, because most people have an accumulation plan And my job is to say, hey, what's your distribution plan? Let me show you how we can grow your wealth better and have your money working for you in more than one way, all at the same time.
Yeah, I love that. In one of our presentations that Finley and I have done, we give a breakdown of a 401k that has $1 million in it. Like, seems to be kind of the benchmark. You got your $1 million and you somehow arrived and you're ready for retirement. And then we also compared that with a whole life policy, and the whole life policy this was a client of ours. I mean, the client, a real client, real illustration, real numbers. And I think it was like 740,000 or something like that in there. And we compared the distribution phase, and in the, traditional, I don't know, I think it was a 401k that we did. As you said, I think we did a 4% safe withdrawal rate, which I know can be on the higher side of what's considered safe, anywhere from, I think, 2 to 4. And, so that's 40 grand gross. We got to take taxes out of that. So you're down to 30, 28, depending on your tax bracket, your tax situation, what that looks like. So you got 28 grand on $1 million. So you're a paper millionaire, but you're, like you said, you're poor. You're living at poverty level. Where does 28 grand go in today's world? I mean, groceries aren't $50 to go to the grocery store anymore. It's $250 to go to the grocery store. So then we compared that with the whole life policy, and the whole life policy had, 25% less cash value in it than the 401k, but there's no taxation. I mean, I don't remember the hard number off the top of my head, but I know it was in the mid 40,000 range that they were going to be able to pull. So you need to spend less time maybe, or put less into a whole life policy to get more distribution out of it, to have the cash flow. And it just goes back to efficiency. That's one of the powerful pieces about the whole life product, is the efficiency standpoint. My background's in lawn and landscape. I started mowing lawns at age 13. If I push mow a lawn, or I have a 60-inch zero turn, it's just efficiency. So if I'm going to be putting my money into something, would I rather have to accumulate way more to have taxes to come down to much less cash flow in retirement? Or would it be better for me to put less money away into a whole life policy and get more efficient cash flow out of that? And what if I put equal in? What if we did the policy illustration was on $1 million of, tax-free cash flow in retirement? I mean, I don't know what those numbers would play out to be, but it would blow the doors off the traditional route. And not that you can't go the traditional route, but it's about having that solid foundation so that as you head into retirement, I've got several family members at that stage where they're either just recently retired, or they've, are approaching that timeline, and they're nervous because they don't have guaranteed money. Their advisor didn't teach them to have guaranteed money. It's all volatile. And if the market crashes soon, which, that news has been on the doorstep for a few years now, and it hasn't showed up yet, but I got to believe it's around the corner at some point. We can't keep doing what we're doing and expecting an endless rising environment in the stock market. So, it's such a shame that people aren't taught how to be efficient for retirement. The focus is on getting that big nest egg in that pile, but we're not trained what to do with that pile, or how to make that pile work for us the best and go the furthest when it comes to the time that we need it. We're not trained in cash flow, and that's a wealth principle. We're trained in middle class, which is the accumulation, and just put a bunch of money away, don't think about it. And this is where I love Garrett Gunderson. This is where he comes in on this it's not just about the money, it's about, everything associated with that money, your emotional state, your state of being with money. And where if you put all this money away and all you're doing is stressing about it, is it really worth going that route if you lose your health over stressing on money? And if you can have some certainty and have guarantees built in, what does that do for your emotional state as you head into retirement, knowing that I've got my bases covered? I know at a guaranteed level, maybe it's through annuities, maybe it's through whole life, maybe it's through whatever other options you want to play with, that you just know for certain what your base is. You can have speculative investing in retirement accounts to go beyond that if you want to. And that's one of the things I love. If you read Garrett Gunderson's book, 5-Day Weekend, that he co-wrote with Nick Halik.
Not yet. Not yet.
Okay. Because in that book, they talk all about really wherever you're starting at, whether you're a W-2 employee or 1099, you're a business owner, whatever you're at, whatever you have for assets, whatever you have for cash flow, it is a step-by-step plan that they lay out in that book on how to safely grow money in a savings environment to where you can start to do like cash flow banking in Garrett's terms, to use it for whole life. Beyond that, get into safe investments, and then do things that are much more speculative at the very end. And that's a very stable, predictable pattern that they've created, that framework in that 5-day weekend book. And we're taught by all the gurus to flip that on its head, right? We're taught, what's day one? I mean, you listen to Dave Ramsey, yeah, you need to have an emergency fund, but after that, go start saving for retirement, put your money in investments, put it in a 529 college plan for your kids. It's all investing, it's all stock market, it's all volatility, and that's like foundational. So we have this inverted pyramid that's not stable, and we wonder why so many people are having trouble with, finances in today's world.
100%. And one of the things that I'm really passionate about, and I want to make a movement around this, is that we're told to do these things. We're told this is the best thing for you, right? Go out and max fund your 401k and pay off your mortgage as quick as possible and don't have any debt. All debt is bad. And we're told all these things, and it's forced down our throat. But each of us has a different philosophy around money, and we have different risk tolerances, and there's different things that are weighted with importance on a different level for each individual person. And the problem is we're not taught how to decipher what our investor DNA is. We're not taught any of those things. So we're told to do all these things, but that might not be in alignment with our values and beliefs. So that can lead to excessive stress. It can lead to depression. It can lead to all these different issues that could otherwise be avoided if you actually knew where your money should be going in alignment with your values and beliefs. So I've been working on creating assessments and different workbooks for people to understand where their values and beliefs align with their money personas, so that they can be more holistic when it comes to investing and where they're putting their money, because all those things have a profound effect on somebody's wealth. And if somebody is super passionate about something, they can create a lot more wealth around that. Instead of just doing this arduous thing for saving for 40 years and then hoping that they'll have enough to retire. And there's nothing more tragic than somebody doing that and doing everything right and still not having a successful retirement. And that's really what I'm passionate about, is like, all right, well, how do we get results quicker while taking on less risk at the same time?
Yeah, totally agree. Yeah, I mean, I'm seeing it right now with my parents. Actually, my dad had actually just passed away a week ago, and seeing my dad was actually in insurance, and they didn't have everything that they could have had set up. They didn't have a lot for money left over, and they didn't have the insurances that he knew how to put that in place. And it's crazy, the information that we get, and just sometimes even we have the right information and we don't execute on it. We know what to do and we don't do it. And I mean, that's across the board, right? I mean, that shows up in our health. It shows up in our relationships. So I know I need to exercise. I know I need to eat better. I know I need to be more romantic with my wife, or I know I need to spend more quality time with my kids. I mean, there's just things that we don't do, right? I mean, that's just kind of human nature. And I think having, systems and financial structures in place, and guys like us and guys like Chris that we're learning under, that teach the holistic view of money, can be so powerful for people, because if you have a system, it can make up for the shortcomings that are the times where we get in our own way and we sabotage our own success. And it's amazing the alignment that you spoke of. I've got a client that was popping in my mind as you were sharing that. We work a lot with like holistic health practitioners, chiropractors, and this one gal, she's an acupuncturist, and she had a 401k that she'd been using because she didn't know what else to do, right? I mean, how often do we hear that? Like, I just don't know what else to do. We're sold the standard party line that gets sold to everybody, but what if, like you said, your goals, your vision, who you are doesn't resonate with that message? Then what else do people have? And that's why we're passionate about what we're doing, bringing this message to the internet and to anybody that resonates with this message, because people need to know the rest of their options. One of my mentors that we first got to know in the the infinite banking space, he always talked on stage about, basically we're given our options, we're said pick from these options. All the while, we've got a whole other set of options that are hidden behind our back. We don't know there's another set of options. And so, sharing the rest of the options. Okay, what if you don't resonate with the volatility? What else can you do? This is where whole life can come in. This is where a lot of different strategies can come into play. And for this client that I'm thinking of, that was an acupuncturist. She's like, I don't like my 401k, but I didn't know what else to do with it. Actually, I hate it. I mean, those were the words that came out of her mouth. Like, I hate this thing. And not just because of the volatility. She didn't like the fund manager that she had to deal with all that, and just not a good relationship there. And she's like, well, I kind of questioned her, like, well, why are we even doing this? And I think that's something that a lot of people have to get to that point of challenging their beliefs and looking at their beliefs around why they're doing what they're doing around money. And I think, by and large, at least I know the people that we come in contact with, there's more and more people that are challenging the status quo about money. I think enough people are starting to see through, call it the matrix or whatever around money, that it's like, there's just not a lot of people crushing it out there with the traditional means. Like, what else can I do? And, that becomes a delicate situation too, because we were talking before we went live about, cryptocurrency and different projects there that, the vast majority of those have all failed and blown up and rug pulled or whatever. And so I know for me, the people that I see and we deal with as clients, they're open-minded where they're looking for a better alternative to the traditional vehicles, but then they can be almost too open to where they want to get into the high risk stuff. And that's where it's a balancing act, right? We got to really go back and funnel people back to, like, what are your beliefs, and making sure that you're in alignment with what you want to risk, and not doing anything stupid, and not letting emotions take over that are going to lead you astray, and making sure that, again, you go back to a proven structure and a proven system around what do we do with our money, and building that foundation first is so vital to making it a success. And then once you've got your foundation set and you've got, maybe some assets that are cash flowing, and, maybe we can probably talk about real estate here in a minute. But you got stuff set up, and then you can start swinging for the fence. So it's a Garrett Gunderson phrase, is swing for the fence, but do it not starting off. Don't, that's not your first at bat. Let's get to the seventh inning, and then we can start swinging for the fences. Let's make sure we just do some base hit singles. It's one of my mentors always talk about. It's whole life are just base hit singles. Let's just keep it simple. It's not exciting, not sexy, but it's going to get you where you want to get. If everybody at bat hits a base hit single, probably going to win the game. If you're going for the fences, a lot of strikeouts. So I love that around whole life, and I love that around what we're doing here with all that. So anything more you want to talk about on the whole life side, or you want to talk about some other things like real estate?
Well, first and foremost, I'm really sorry to hear about your dad, man. I didn't know about that. But one of the things that came to mind was you had said that somebody started swinging for the fences, and they're just going for that home run. And really, what I think the biggest problem is there is they don't know what their risk tolerance is in the first place. And they don't have an understanding of what risk is or how much risk they're taking. They haven't really looked at their whole financial picture and said, if I go forward with this, I could lose it all. Mm-hmm. And I almost fell victim to that with my own business that failed back in 2020. And so understanding what your risk tolerance is, I think, is really huge. And then, like you said, knowing what other avenues that you can invest money and grow your wealth is super important. But another thing with this whole thing, you mentioned, if you're swinging for the fences, you really want to create systems and processes like what Ray Dalio did. He's like one of the most successful hedge fund managers in the history of the world, and he basically he figured out that he was fundamentally flawed. Like he figured out that he could be wrong. So that's why he created structures and processes so that he could not fall victim to his own biases. Mm-hmm. And so he created those mechanisms and the mechanics of how he traded to become far more successful. And I think that's what everybody needs to do with their own life. Like, one of the things that pretty much everybody will fall victim to if they don't put something in place is something called Parkinson's law. And Parkinson's law states that as your income grows, so will your expenses.
Hmm.
And if you don't put something in place for those expenses to not rise, like if you're like, you could structure it in a way that money automatically goes into an opportunity or emergency fund instead of your lifestyle creep increasing. These little mechanisms and these little psychological hacks that we can implement in our lives are super important, but we're not really told about this in school. So, my goal is to get that information out there and say, hey, look, there's a better way to do this. It's not going to impact your lifestyle, and you're going to be far better off in the future.
Yeah, Parkinson's law is so huge, and I think about one of the keys you just said there is getting into debt, or if you're spending too much, and how Parkinson's law can take over. And I did a podcast with a chiropractor a few weeks ago, and I was querying him on, he deals a lot with weight loss with females, and I said, what are some of the key things that keep the weight off, that keep somebody successful, so they're not yo-yo dieting and they're actually making a lasting change in their life? And he said, well, I always quiz people down to, I think he said 7 layers of why. And like, why do you want to lose weight? Well, so I can look better in the summer. Great, that's an awesome goal. Well, why do you want to do that? And just dig deeper, deeper, deeper. And with debt and spending and wanting to always raise your lifestyle the minute you have more money show up, we have to look deeper than that. And I'm saying this for myself because I fall victim to this big time. It's very easy. I grew up, I had, good cash flow growing up. I had brand new trucks in my landscaping business and jet skis. And then, adult life hits and you've got different responsibilities. And if you have things like we had happen, we had an accident 11 years ago where we were hit on foot down in Florida by a car, my wife and I, and, life looked different after that accident for a while financially. And it was a hard pill for me to swallow. And, I've had to look at, and I still need to do more of it, quite honestly. Why do I have this impulse to constantly scale my income the minute more money shows up? And so digging deeper into why do I need to do that? Why, if there's a debt situation, you're chronically in debt and you can't seem to change that, you need to work with somebody that can get deeper than just a cut up your credit cards type advice. Like, that's just symptom. That's just putting a band-aid on it. That's unplugging the check engine light on the back of your dash and going, oh, problem's fixed. No, it's not fixed. You just masked a symptom. If you cut up your credit cards or put your credit card in a big frozen block in the freezer, like I laugh at those kind of things, as like, that's really a solution. And it probably works for some people. That's what they need to hear. But for some of us, we need to go deeper than just cut up our credit cards. We need to really dig into, like, why is this the case? Did I view debt growing up a lot and it's just I'm modeling it because that's what I observed growing up? Or is there something else going on? Is it just, maybe you've got a spouse. I had a girlfriend years ago that, she wanted whatever she wanted and she expected to be bought whenever she wanted it. And, if you swipe the credit card too many times, like, you can have a spouse that, gets you in trouble if there's not the discipline there. So, I'd encourage anybody that, feels like Parkinson's law is kicking in their life, take a deeper look at that, like really analyze that, work with a coach or somebody that can dig deeper on that, because if you want to make changes for wealth and do better with money, you've got to figure out the psychology underneath all this and what's driving your decisions and your habits and the patterns that you have around money, because you'll never really truly make a change. You might for a little while just out of sheer willpower, but the subconscious patterns are going to pick right back up and take you right back down a road you don't want to be down. And but yeah, Parkinson's law is very real. I mean, I've been through it on kind of both sides of it over the years. And when I learned, I didn't know the principle existed by name, but when I got into all this and learned about it, it's like, oh my gosh, totally there. And if, like you say, you don't have a plan for it, you don't know how to accommodate for an increase, whether it's your sales increase, or if you're a W-2 and you have, you just get a raise from your boss or something. Like, if you don't know what you're going to do with that money, and one of our strategies would be, okay, if you got an increase, put it into a whole life policy and leverage that money for the rest of your life and get the death benefit for it and have the access and liquidity to the money if you want it, and all those different benefits that come with it. Now, that's the only thing you can do with it, obviously, and you could put that money in a some sort of cash flowing real estate or something that you want to utilize that for down payment or something. But Yeah, that's just kind of my experience with all that. So I wanted to share kind of my own stumbling points around that, and still an area, quite honestly, I need to still dig into deeper. What I said was for me, I needed that reminder of like, I got to go deeper than what I've done, because it's very easy. You think, oh, I've got this commission coming, and my wife and I are really good at figuring out like, okay, what can we go do? What can we upgrade? What can we do here? What can we do there? And it's like, gosh, I'm falling into it again. It's very easy to be lured into it.
100%. But we're all human, and I think it's important to have progress over perfection.
Totally.
So, if at least you're aware of it and you're working towards it, that's the biggest thing. Because no matter how great we are with our finances or how much our income is, we can always be better. And if we, have that goal to, try and manage our finances better and just be more aware as a human in general, I think that's going to definitely lead to just living a happier, more intentional life.
Hmm. Totally. So before we came on, you were talking a little bit about some of your real estate strategies. So I'd love to hear more about that. I'm familiar with some of those from my good friend Jeff Finley. He's done a couple of those strategies, and we've looked a little bit at the replaceyourmortgage.com, which I know shares some of the same strategies. But I thought it was pretty cool what you were sharing with me and how it works with whole life. So I'd love to hear more of what you're up to there, and just kind of some of the hacks around that you've found that work well on saving interest, and some tax strategies around that and stuff you were mentioning earlier.
Yeah, 100%. So I'm not only utilizing cash flow banking strategy, but I'm also utilizing velocity banking, which are two different things. But I currently live in California, and property values are ridiculous compared to the amount of rent that you can get here.
Mm.
So it just really doesn't make sense for me to buy property in California. Plus, it's a blue state and it's too renter friendly. And I'd rather have more control over my properties. So therefore, I've been buying properties in Huntsville, Alabama, brand new properties in Huntsville, Alabama, more specifically, which is an amazing place to buy property. Um, but the way that I'm leveraging everything is I'm using what's called a all-in-one loan, which is a first lien HELOC. And what that is basically your typical mortgage is a 30-year loan, and you're going to pay a tremendous amount of interest into that loan over time. So the way this HELOC works is all of my extra cash flow, all of my like money that I would typically save and either put in a bank account or a whole life policy, whatever, instead is getting dumped into this HELOC, and it's paying down the actual principal of that loan. And as I pay down that principal of that loan, my cash flow is also increasing from the rental income of that property. So I'm becoming efficient on two different ends, right? But as I pay down that mortgage or that HELOC, what I do is I'll go out and put my money back into another whole life policy. And so now I have the cash value of that whole life policy. And then what I do is I'll take the cash value of that whole life policy and pay down that HELOC. And now instead of having, let's say, for instance, an 8% interest rate, now I have a 5.5% interest rate. So I'm reducing my exposure to interest, and I'm growing my money in multiple ways at the same time. So I got the uninterrupted compound growth of my cash value in my insurance policy, but I also have better cash flow because I have less of a percentage rate that I'm paying towards interest. So it's a complicated process, and I have to make more content around how the whole strategy actually works for people to actually implement that in their own life.
Yeah. Yeah, I know a little bit that we've dug into it. I mean, I haven't done it personally, but I know looking into it, it was like, wow, that's a really cool strategy that, you're, like you said, your paycheck or whatever goes into the first position HELOC, and, is bringing down the average daily balance. And then it's just math that takes over at that point. I mean, if you're constantly putting more money into that, and you might pay your bills out of that, and you're still using it, but overall the balance is going down more. And, if in a 30-day cycle, there's a lot lower of a balance because of the extra money that you have in there before you paid your bills, there's less interest being charged on that. And it's a great strategy for, like you said, probably not the rookie starting out, but it can be a great way to be more efficient.
You have to definitely be extremely disciplined when you're using that strategy. You have to have a track record of saving money for a long time before you even want to implement a strategy like that. Because if you don't add extra money into that account, it's going to work against you. So there's that downside. But by leveraging the whole life policy, you're reducing the risk because now you have an unstructured loan using your whole life policy. So that's another reason why I'm utilizing those policies and also making my money work for me in multiple ways at the same time. And just by me buying new properties in Alabama, I'm also able to capitalize on uh, having better tax efficiency as well. But I definitely recommend if anybody uses this strategy that they talk with a tax strategist first before they implement any of the whole ecosystem of the way the strategy works.
Yeah, totally. It's a cool strategy. I would like to get into it a little bit more. I mean, real estate's one of those things that even the 5 Day Weekend book that I mentioned, there's a pretty extensive chapter in that book talks about real estate. And it's a area that I haven't dabbled in too much myself at all. But as wealth continues to increase, I know it's one of the go-tos. If you listen to the Robert Kiyosaki's or Grant Cardone's, real estate's where it's at. And I guess what have you found, Charles, where kind of goes back to values and beliefs, and is it the right fit? Where have you found that somebody should pursue real estate and it is a good investment for them versus hey, maybe this isn't the best thing for that type of person? Does it go back to investor DNA, or what have you found in that area?
Well, if you want to become more tax efficient, real estate is a great vessel to utilize when structured well and having the right team that knows how to do everything legally and making sure that you're dotting your I's and crossing your T's. Um, but not only that, the way that I see real estate is there's actually a purpose and there's utility behind it, and you can't multiply or you can't create more land, right? So there's only a finite amount of land, and as long as they're printing money in the Federal Reserve, um, then I don't see why the prices aren't going to continue to go up. So you're hedging your money against inflation. You're creating cash flow. You're reducing your tax liability. So when you put all of those different things together, like maybe your first few years don't make sense at all. It's like you're maybe breaking even, or maybe you're putting $100, $200 a month into that property just to keep it, just to get into the property. But if you're looking at it from a long time horizon, if you're looking at it from what is this going to do for me 10, 20, 30 years from now, right? When your mortgage is paid off and you have all that cash flow, but if you remember, it's going to adjust with inflation, and your mortgage rates are going to your rental rates are going to go up, and you're not going to have that mortgage. It's going to act as a retirement income for you. Or you could sell that property, you could buy an annuity and have true passive income, which I believe that's what an annuity is. But just, putting your money in an asset like that really will amplify your wealth. And I think it's just a great way to build wealth and grow passive income, even though it's not an immediate solution. It will take time.
Yeah, for sure. So I know, one of the things that I've always heard about real estate, and one of the things is like, well, I don't want to have to manage properties and that. So what is your experience, and what options does somebody have? I mean, they don't have to just go and do the duplex thing and manage it themselves and fix the toilets. I mean, there's options for people, right, to get into the game but not have as many of the headaches on themselves, right? I mean, what are some of those structures that somebody can put in place to make it as hands off as possible and still utilizing the benefits you just laid out?
Yeah, that's a fantastic question. And the properties that I'm buying, I don't actually even look and see. Like I don't like I see them pictures and maybe some video, but I'm not there boots on the ground. And I
Mhm.
don't have to be. And the reason I don't have to be is because I did a lot of due diligence into the property management company that I wanted to utilize. And so when you think about buying investment properties, especially if you're going to be hands off with it, you really want to think about, and like the key part of all of it is, who's your property manager, because they're the people in charge of, they're basically in charge of that property. They're in charge of, the maintenance. They're in charge of the tenants. They're in charge of basically everything. So you want to be partnered with somebody that you can absolutely trust. So I spent a lot of time vetting all of the different property managers in the area, and I found somebody that I absolutely love. Like they completely take care of me. I can sleep totally great at night because I don't have to worry about that property. It's just, it like, yeah, everything's good. They market it amazing. They get tenants into the property in like record breaking time. And so that's really the key, like where I don't have to worry about how that property is performing, or if the tenants are going to pay or anything like that. Just really, property management is key to buying property, especially out of state, and just having that team that you can trust, right? And so, you know, that's like the number one right there when looking for property, is like, who's your property manager? And then everything else follows. Is that area growing? Or is there job growth? Is there population growth? Is the median wage increasing? Right. And you're looking at all these different factors, but after you find that property manager.
Cool. That's good stuff. Yeah, and it's one of those things that, as a novice in it, it's very intimidating thinking about, like, oh my gosh, what would I do? And then if you get into that, then you find that property management. And is it something that you always have to do? Like, if somebody wanted to get into real estate, is it something that, I would have to do that vetting, or are there like the Grant Cardones or Robert Kiyosaki's? Can you go and like work alongside of systems that they've already developed and plug into systems out there where you already know, maybe there's a database of like vetted property managers? Like, what does that look like? What's that you know
So
space look
I
like?
mean, there's a ton of resources out there. And there's different funds, and like you said, there's the Grant Cardones and the Ken McElroys, which is basically like a Grant Cardone. Um, but really, like I'm more than willing to share who I use, because I think she's amazing and she's got a great team behind her. But there's also resources like Bigger Pockets, and there's a whole community. But the key is really just understanding the mechanics behind it, and then making sure that those mechanics are executed the way they need to be, and just really trusting that person. You're looking for like A-type personalities, where they're just like so detail oriented, and they're like on top of it, and they're thinking ahead. Like I don't have to babysit or ask them anything. It's like, oh, that's already been done. Oh yeah, you already got a tenant there. Oh, this and that. That's what you want, right? Like that's hands off. And so there is a fee for that, right? You're going to pay a property management fee, but you just equate that into the underwriting of the property when you're doing that. And you can use calculators. I use a Bigger Pockets calculator when I'm underwriting everything like that. But another thing is, I'm buying new properties, so I shouldn't have any capital expenditures. I shouldn't have to pay for maintenance for a good amount of time
Mm.
before things start falling apart. And by the time they do start falling apart, that property is going to be cash flowing pretty well, where that's not really going to affect me. And all the property, the whole portfolio will be cash flowing well, where I can just start renovating, and upgrading everything that needs to be upgraded over time.
That's awesome. I love that strategy, that you're kind of cutting out one of the big complaints of, the roofs and the, repairing all the toilets and having to revamp the kitchen. I mean, I've heard enough of those podcasts of the guys that go in and, gut stuff out and put 30 grand into the home before they're even, getting a tenant into it. And I love that strategy, that you're, like you said, bypassing all that for the first, I don't know, what is that considered? First 10 years or so, that before you expect to start having to replace stuff?
I would say first 10 years. And some things to consider: you have a warranty typically for at least a year, and there's other warranties that you
Mm.
get within the property. And also you get, I'm not sure what the tax laws will be in 2025 or 2026, but As of right now, I believe you can get bonus depreciation. So instead of having to divide how much you can write off over 27 years, you could basically write off that entire property after year one. So
Mm,
if you have a big tax liability, you can depreciate the whole thing and kick that tax liability to your death using 1031 exchanges and different strategies like that. But of course, you always want to consult tax strategists because that's how I understand it. But that doesn't mean that's 100%
sure.
how it works. So.
Yep. Got to throw in that disclaimer, right? Yeah. So besides real estate, you got any other investment, vehicles or areas that you like to put capital in and put it to work?
I have a 401k and I match it, which, that's just there. I just match it because that's 100% return on my money. Besides that, just growing the business and helping as many people as possible are my main goals. So it's putting money in whole life, putting money in property, growing the business, and just keep pushing forward.
Cool. I love it. So I'm thinking bring the conversation full circle. And so is there some strategies that utilize whole life in the way that we write it, where it's cash value, dividend paying whole life insurance with real estate? I know there's some discussions out there. I know Chris Kirkpatrick's talked about it a little bit, but do you have some things you want to share about how those two things can be used, synergistically? I mean, you kind of mentioned a little bit with velocity banking and kind of using the whole life on the back end. Was there any other good pairing strategies that you take the whole life and can utilize it with real estate that people might want to know about that can help them be more efficient with their money as they're doing real estate?
Yeah, 100%. I mean, you can use your whole life policy if you have enough to fund it. You could be a hard money lender, and that's a super powerful way to grow your wealth. You could fully finance a house using whole life policy, and that can be an amazing strategy as well. Or you can do the hybrid strategy that I'm doing, where I'm using the velocity banking, the HELOC, and the whole life policy at the same time, and I'm able to shift that money back and forth to make it as efficient as possible, all while reducing risk.
Mm-hmm. Awesome. Love it. Cool. So
Yeah,
if somebody wants to find out more about you and, the information you're producing, you have some
yeah,
resources that you can
definitely,
share.
definitely. You can find me on Instagram at Secure Harbor Financial, and also my YouTube channel, Secure Harbor Financial, as well. Find me there.
Love it. Cool. Well, good chatting with you. We covered some good stuff today. Hopefully people find a lot of good value in it, and look forward to doing this again, hopefully. So thanks, Charles.
Thanks for having me, Jeff. Appreciate it.
Yeah, you bet.